see we've got Tim with us, so it's not Sophie, it's Tim who's joined us today, just to avoid any confusion there. And can I say welcome to Tim and welcome to everybody else as well, because actually the interest in this session is really fantastic and probably a lot better than we were expecting it to be. So thank you to everybody for responding and taking the time out of your day today to come and join the session. So I suppose the question is, why are we doing this? You'll know that we've been sending comms out through Amanda's blog and broadcast and some email comms as well about the fact that the reevaluation has taken place again for SHPS. So if you've been with Black Country for a while, you know that that happens every 3 years. And last time we did the consultation, you'll know that we closed the final salary scheme and those people were offered the opportunity to move into a career average scheme, and our costs increased. So this time we want to be on the front foot and we want to make sure that we're giving people every opportunity to raise their own understanding and awareness about pensions, so that at the point where we start consulting with you guys on what the new pension arrangements might look like, hopefully you'll be able to make more informed decisions about what you do about your pension membership. So I sent a survey out to a group of people. This isn't Black Country transcription, isn't it? This, if you can see it, it's very distracting in the corner of my eye. But we sent out a survey to a cross-reference of staff. We didn't send it to all staff because I'm really conscious of survey fatigue. So I chose about 50 people, so a cross range of genders, ages, ethnicities, length of service. I tried to capture everybody, and we asked for your feedback through a survey, and we shared that with Tim and Sophie from Isio so that they could use that information to frame what this awareness session will look like today. So it's based on colleagues' feedback of where we felt sort of perhaps some of the gaps in knowledge are, that's helped to inform this session today. So there will be opportunities for questions at the end. So, but Tim is happy for you to drop questions in the chat. If there's any sort of questions that I can deal with after the session, Tim won't respond to those because we'll sort of use his time more valuably answering questions that I can't answer. Yeah, if you could drop your questions in the chat or save them up till the end. And I think that's it, Tim. I'm going to hand over to you now, if that's okay.
Brilliant. Thanks very much, Sarah. I'm just going to share my screen then. This was the first challenge, just to see if everyone can see that. So I think you should be seeing a slide that says pension awareness. Can everyone see that? Yep. Perfect. So very sort of brief introduction then. So my name's Tim Demansky. I'm a pension specialist from a firm called Isio, and I'll be guiding you through this pension awareness session over the next 30 or 40 minutes. And I guess, as Sarah said as well, please feel free to interrupt me and ask questions as we go along. I guess it's much more, I'm going to use the word enjoyable, but I know it's a pensions topic, but it's much more enjoyable if everyone kind of engages with it and we can have a bit of a dialogue. Okay, so moving on next then. So just what are we going to cover today then? So very briefly, I'm going to talk about why we have pensions and where the sources of pensions come from. I'll touch very briefly on the state pension, but where I spend most of the time today, we'll be talking about the Social Housing Pension Scheme, or SHPS for short, which is where Black Country Housing provides its pensions from. And then there'll be an opportunity for questions at the end as well, if you want to save them for the end. So, what do we save for a pension? There's probably loads of reasons, but I think the three top ones are it provides an income on retirement, and they generally provide other benefits as well, so a spouse's pension on your death and ill health benefits as well, and I'll talk more about those a little bit later. And then lastly, pensions are generally a very tax efficient way of saving for retirement. So when you put contributions into a pension scheme, you get tax relief. So if you're a basic rate taxpayer, £100 only costs you £80. If you're a higher rate taxpayer, £100 only costs you £60. You also get tax relief on any investment returns in your pension as well. And it's only when you start drawing your pension at retirement that you start to pay tax. But even then, you can take up to a quarter of the value of your pension as a tax-free lump sum. So it's a very tax efficient way of saving just in general. Just saw a question from Eamon. I think the answer is yes. We will be sharing a copy of these slides at the end of the session. Where do sources of pensions come from? So where do we get pensions from? So we've got three main sources here. So the biggest one is from the state. you pay national insurance contributions, and in return for that, you get your state pension. Next is the employer-sponsored pension. So that's what we're really focusing on today. So you and the employer pay money towards a pension that you can take at retirement. And then lastly, there's a personal pension. It might be something that you set up yourself, like a personal pension plan or a savings account. Touching very briefly on the state pension. So you pay national insurance contributions in return for a state pension at your state pension age. Currently, the full basic state pension is around £9,300, but it will depend on different circumstances. So I guess one of my takeaways I'm hoping people have following this session really is to click on these links, these government website links, really to understand what your state pension forecast is. And you need your gateway ID for that. And also to understand what your state pension age is as well. I think it's currently around 66, but it is planned to increase over the next few years as well. So that's, I think, all I was going to say on state pension. And I was going to move on to the social housing pension scheme, or SHPS. So the social housing pension scheme is a multi-employer sector-wide pension scheme, and many housing associations provide their pensions through SHPS. It's governed and looked after by a company or a trustee called the Pensions Trust, or TPT for short. So they look after SHPS. They also look after other multi-employer pension schemes, like the Scottish equivalent of the social housing pension scheme called SHPS, and a few others as well. And within SHPS, there's two main streams of benefit types. So there's the SHPS defined benefit, and I have a final salary and a career average part, and I'll talk about what they mean in a few slides' time. And they also have SHPS DC, or defined contribution as well. I'll cover that a little bit later. When you join Black Country Housing, I think all employees are automatically enrolled into the defined contribution part, but you can choose to join the defined benefit or the care part of it if you want to. And over the next few slides, hopefully I'll kind of draw out why you might want to choose one rather than another. I guess just before I go any further though, what I'd like to do is do a mini survey. So really using the sort of the thumbs up functionality on Teams. So if you don't know how to do that, there's a little smiley face with a hands up. And I guess I'm just going to ask 2 or 3 questions really. So question 1, just a quick survey. How many of you are in the SHPS DB part, or do you know if you're in the SHPS DB part? It's got a few hands going up there. Okay, thank you. And then how many of you are in SHPS DC? A few coming up as well. And then I guess most interestingly, how many of you are not sure which pension scheme you're in as well? Or you're in no pension scheme? A few people. Okay, so hopefully then there'll be content in this session that will help everyone who's on the call. So we'll spend time talking about DB and what that means, and DC and what that means as well, and hopefully how to find out a bit more detail on which pension scheme you're in. So focusing first then on SHPS DB, so defined benefit. So very broadly, what makes a defined benefit scheme, or what's its sort of key feature? Well, the key feature is the benefits you get at retirement are defined in a defined benefit scheme. So effectively you build up a pension promise that's set out in the pension scheme's trust deed and rules, and it's normally some function of your salary, the number of years you've been in the pension scheme. So I guess just looking at this chart here, so and what I'm trying to draw out is what's the sort of known and fixed parts, and what's the unknown and the variable parts. So your pension benefits at retirement are relatively known, relatively fixed. And similarly, your contributions are relatively known and fixed. I mean, they'll change from time to time, but you've got a relative amount of certainty with those. What is unknown, though, is the assets that are kind of underpinning that promise or underpinning that benefit. So you're relying, I think the trustees will be relying on investment returns to kind of meet that promise. And if there is a shortfall, the employer will need to meet that deficit. So they'll need to pay higher contributions. So that's kind of like sort of the conceptual level. So what does this mean in practice? So picking on the sort of final salary pension to start with. So the final salary pension is made of 3 parts. It's your pensionable service, so the number of years in the pension scheme. It's It's based on your final salary, which is a function of your salary when you leave, which is based on an average of the last 3 years, and then the pension build-up rate, and multiply those three together and you get your annual pension. So we've got an example here for a member who's been in the pension scheme for 10 years. They're on a final pensionable salary of £24,000 and the build-up rate was 1/60th. So that would equate to an annual pension of £4,000. That pension's payable for life. It'll increase with inflation. And when you die, there'll be a spouse's pension and lots of other benefits available as well, which I'll cover off a little bit later. As you'll probably know, I think Black Country Housing stopped building up pension on a final salary basis from 2019. So, and then it started to build up new benefits on the career average basis. So what this means is everything you built up before 2019 is effectively frozen. So it won't grow anymore with pensionable service, but it will grow with salary increases. So then moving on to the sort of career average, and I think it works in a very similar way to final salary, but rather than looking at your salary at the end of your career, it tries to effectively average your salary over your working lifetime. And how it works is every year in the pension scheme, you effectively build up a block of pension, and that block of pension is equal to your salary times your build-up rate, or divided by your build-up rate. At the end of the year, that block of pension is effectively banked, and it will grow with inflation, and you'll start to build up a new block of pension. Over time, you'll build up more and more blocks, and all those blocks combine together as your pension at retirement. So I'll try and bring that to life a little bit with an illustration. So say you started to build up a pension in 2020, so you build up that block, and then that keeps growing, and it will grow with inflation for the next few years. 2021, build up a new block of pension, and again that grows with inflation. And in 2022, you'll build another block of pension, and it's all those blocks together that is your total career average pension. I'm not going to do a sort of numerical example. It can get quite complicated, but if you are interested and want to see some numbers behind there, there is I think the member booklet has a worked example towards the back as well, so it might be interesting to kind of look through that in a bit more detail. So what does it, I guess the other side of it is what does it cost you to build up this career average pension? So currently you pay 9.5% of your salary, and Black Country Housing pays 7.2%, plus any shortfall or deficit payments. And I guess by shortfall and deficit payments, what I mean is when the trustees carry out this 3-yearly valuation to check if the pension scheme has enough money to cover or secure the benefits they've already promised. If it doesn't, then the housing associations, including Black Country Housing, have to agree a sort of deficit or recovery plan to recover that shortfall. Any questions at that point? Nope. So focus very much on the income side of things. So what you'd receive on retirement as a sort of income stream for the defined benefit pension. But I now just want to spend a few moments just really talking about the optionality you've got, and also the sort of additional benefits. And so the top row really focusing on the options, and the bottom row focusing on benefits. So firstly, you can give up or choose to give up part of your pension for a tax-free lump sum. So you can have a tax-free lump sum in return for a slightly lower pension. Next, you've also got options around when you can take your pension as well. So currently the minimum retirement age you can start drawing your pension is 55. And you can take your pension anytime from that age. I guess kind of what happens though is pension schemes typically have an assumed retirement age, and if you go before that assumed or normal retirement age, the pension is reduced to reflect the fact that it's payable for longer, and the trustees have less time to earn investment returns on your money. And I guess the opposite is true as well. So if you retire later than the assumed retirement age, the pension is uplifted on the basis that you'll be expected to have fewer pension payments than you would have done at that sort of target or assumed retirement age. And the concept of a sort of a normal or assumed retirement age is quite interesting for pension schemes like SHPS and other defined benefit schemes, in that there's typically have more than one. So if you look at the member booklet, you'll see that your assumed or normal retirement age is age 67, but that only applies for benefits that you built up from 2016. If you're in the pension scheme before then, your normal or assumed retirement age would be 65, and if for benefit before 2016, and if you've been in the pension scheme before 2002, your normal retirement age would be 60 on those bits of benefits. So just to try and bring that to life a little bit, if you've been in the scheme since 2010 and you wanted to retire at 65, the part of your benefit built up between 2010 and 2016 wouldn't be reduced at all, but your benefit built up between 2016 and now would be reduced because you're taking your pension 2 years early. There's another option I just want to talk about as well called a transfer value. So within the SHPS DB, you've got a pension promise. If you want to take that pension promise and transfer it out, you can request something called a transfer value. What this does is it puts a pound amount value on your pension promise that you can use to take to another pension scheme, typically the sort of defined contribution, or you might hear the phrase money purchase type arrangements. So you can kind of move it around to get more flexibility. If the size of that transfer value is bigger than £30,000, though, you need to get financial advice before you can action that request. So that's just some of the sort of optionality you can have within SHPS. There's some optionality on death benefits as well, which I'll cover off in a few minutes when I talk about sort of bottom row on the slide. So what happens to your benefits on leaving? So if you decide to leave the pension scheme, your pension promise still remains. It doesn't grow anymore. It doesn't build up anymore with service, but it does grow with inflation. And then when you come to your retirement age, you can draw it in a similar way that you would have done if you carried on working in the scheme until retirement. You also have a number of death benefits as well, and the death benefits are slightly different if you die whilst working for Black Country Housing, or if you don't work for them but haven't started drawing your pension, or if you started drawing your pension. And I think probably what I'd like to do is kind of refer you to the booklet to kind of read that in a bit more detail. But just to give you a little bit of a flavour, death benefits generally come in three forms. There's generally a lump sum part, there's a spouse's benefit payable, and also a children's pension. And kind of using the sort of death in service or death whilst employed as an example, if you die before retirement, from a lump sum perspective, it's 3 times your salary, plus any refund of contributions you've paid into the pension schemes with interest. From a spouse's pensions perspective, it's 50% of your pension at date of death, assuming that you'd worked until age 67 as well. So it's quite a generous uplift if you're a number of years away from reaching 67. So if you're dying before retirement. And then there's also a spouse's pension payable as well. A child's pension payable as well, which is 12.5% of that sort of prospective pension, and that's payable for up to 4 children. And if you don't have a spouse, it's uplifted, and the amount payable to the children are uplifted as well. You also have some options with death benefits at retirement as well. So you can flex that spouse's pension. So if you're not married and you don't want a spouse's pension, you can choose to exchange that for a higher pension that you receive. Or alternatively, if you want to give more pension payable to your spouse on your death, you can choose to give up part of your pension in the same way that you do tax-free cash for a higher spouse's pension. I guess one of my main takeaways on this slide, or what I'd like to be one of the main takeaways, is really around the nomination or expression of wish form. So kind of think of it kind of like a will, but for pensions. So if you do pass away, the nomination and expression of wish form really helps the trustees when they need to make and apply their discretion in paying any sort of lump sum and pension benefits. So what I would encourage people to do if they do have the time is really to log on to the TBT website and make sure that their expression of wish form is up to date, because it just makes it a lot easier if the worst case happens. The last part on here as well is around ill health benefits. So there are some ill health benefits available through the SHPS pension scheme. They'll depend on, I guess, medical circumstances and situation, but it generally means if you meet certain criteria, you might be able to take your pension before age 55, and it might have some prospective elements as well. And again, I think if this is likely to apply to you, if this is something you're concerned about, I'd encourage you to look in the member booklet, and there will be a link in the back of this pack as well that kind of directs you towards that. there any questions on the sort of defined benefit part before I move on to the defined contribution aspect? Perfect. And the other mainstream really is around the SHPS DC or defined contribution, or you may hear the term money purchase. And very much the defined contribution pension works similar to a stocks and shares ISA. So you pay money, the employer pays the money. Hopefully over time that pot of money grows with contributions and investment returns. And then at retirement, you can access this money in a number of different ways. Just stepping back a bit to the sort of known and unknown, or the fixed and variable parts. So in the defined contribution scheme is the contributions which are defined. So typically you and the employer have almost like rules or a choice on what contributions you want to pay. But what's not known or what's variable is the investment returns and the pot of money you get out of it at the end. And if that pot of money is lower than what you were hoping for, the onus is on you to kind of top that up rather than on the employer for the defined benefit scheme. Currently in the SHPS DC scheme, in terms of contributions, you pay in 4% and Black Country Housing pays in 4% as well. One thing I'd like to touch on with DC pension schemes, just in general really, is around the flexibility at retirement. So there's a lot more options compared to the sort of more traditional defined benefit scheme. And I kind of think of it as a sort of sliding spectrum really. So at one end, you can buy yourself a pension that might look and feel a lot like the SHPS defined benefit pension, so payable for life with a spouse's pension with pension increases. So that's the one end of the spectrum. At the other end, you've got complete flexibility on how to draw it. So you could take the pot of money in one go. 25% of that pot of money would be tax-free, with the rest of it taxed at your marginal tax rate. And I guess if you did take it all in one go, you can think of it as almost like taking your salary in 1 year as well. So if it's a large amount of money, say it was a pot of 200,000, you'd get 25% tax free. Some of it would be on the 20% tax rate, some of it would be on the 40% tax rate, and some of it would be even higher as well. And so it tends not to be a very tax efficient way of taking it. And I guess you can kind of go in between as well. So you can take some of it as tax-free cash and buy the rest of it to buy an annuity, or you can flexibly access your pot of money as well. So rather than taking it all out in one go, you could take it out over a number of years, almost like doing a DIY pension yourself. And every time you take that slug of cash out, 25% of it will be tax-free, and the rest of it will be at your marginal tax rate. When you're buying an annuity as well, I guess because you're buying it from the open market, so from an insurance company, rather than being constrained by the trustee and rules of the defined benefit pension scheme, you've also got a lot more options as well. Got a couple of examples here, so you can kind of really tweak it to meet your circumstances. So if you're poorly, you might be able to get enhanced terms compared to someone else. You don't need to buy inflationary increases as well. So rather than having a pension that's a bit lower and then increases over time, you could choose a higher pension that's flat and doesn't change in the future. And again, you've got this option about flexing your dependent benefits, so whether you have a spouse's pension or not. In terms of investments and how the investments grow and the sort of decisions that you'd be needing to make, I think that there's kind of two sort of avenues for it. So firstly, there's a sort of default investment approach. And I think within SHPS DC, there are two funds to choose from. So it's the target date fund and the ethical target date fund. So one that focuses more on socially responsible investments. And these are examples of lifestyle funds. And what that typically means is when you're younger and further away from retirement, the funds will automatically choose higher returning but riskier assets. And then as you get closer to your target retirement date, they'll move into safer assets like cash and government bonds. So you've got that sort of security. So that's the sort of default approach. You've also got flexibility to go with the sort of self-select funds as well, where you can choose from 1 to 7 funds to put your money. So you can put it all in one, you can spread it across all 7. And then really you're managing how those pots are invested over time. I guess return and risk is one thing to think about with these funds. I guess the other aspect to consider as well is really investment charges. So target date funds, investment charges about 0.5% per annum. The ethical equivalent is a little bit higher, so 0.7%. And then with the self-select funds, it goes between 0.5 or just below 0.5 and just over 1%, plus there's a top up for the property fund on top as well as that. These aren't charges that you pay. You wouldn't be asked to pay these separately. These are effectively, I think of them as a bit of a drag on your investment returns. So they're taken from the fund directly. In terms of retirement date and retirement age, it's kind of an interesting concept for a defined contribution fund. I guess what you've got really is ultimate control on what your target retirement date is. So you could choose 55, you could choose later. I think the default is 65, and you can change that by logging into the TPT website. And you can also go in and update that over time as well. So if you want to make it the same as what the SHPS DB is targeting, you might want to do 67. If you've got it in your mind that you're targeting an earlier retirement age, it may be beneficial to change that as well. I'm kind of showing this slide again, but this time from a sort of DC perspective, so thinking about the income and other benefits as well. So we talked about the flexibilities on how you can access the pension already, and part of that is the tax-free cash as well. I think we just covered off as well the sort of ability to early and late retirement, and actually you're setting the assumed retirement age. So there's no, I guess the concept of early and late retirement is a little bit more fluid. And because it's a defined contribution pot, so it's this pot of money, it's a lot more portable than a sort of defined benefit equivalent. So what happens to your DC pot if you leave employment? Well, you've still got that pot of money, and hopefully that will grow. But that will depend on investment returns rather than inflation. So depending on what you're invested in, it may go up and it may go down. There's also death benefits associated with the defined contribution pension scheme as well. These are very much focused on the lump sum and the pot of money being payable to a spouse rather than sort of annuities or sort of spouse's pension. If you do use this pot of money to buy a pension with an insurance company, and you do buy a spouse's pension, then the death benefits will be what you've agreed to buy. I'll also add as well that if you do die whilst you're in employment with Black Country Housing, you still get that 3 times pension salary as a lump sum payment. There's also kind of the concept of ill health benefits as well, and again, there's different requirements on what it needs to qualify for you to be able to access your benefits earlier. And again, I'd kind of direct you to the member booklet to understand that a little bit more. So kind of that brings me to the end of the sort of defined benefit, SHPS defined benefit and SHPS defined contribution sections, but I just thought it'd be helpful to do a little bit of a compare and contrast. So from a defined benefit perspective, the benefits are known in advance, but the contributions aren't. Whereas it's the opposite case with defined contributions. So the benefits aren't known, so you don't know what that pot of money is going to be, but the contributions are known in advance, so it's at 4% and 4%. The benefits at retirement in a defined benefit scheme are governed by the scheme rules. So you do have flexibility, some flexibility, and you do have options around that, but you've got much more flexibility in a defined contribution pension scheme where you can choose how and when you draw from that pot of money. From a defined benefits perspective, if there's not enough money in the fund to meet that promise, generally it's the employer that needs to pay more to make good on that shortfall. For a defined contribution scheme, the onus is really on the member. If the pot of money is not doing as well as you might expect, then you need to pay higher contributions. And just stepping back from a sort of governance perspective and what the role of TPT and the trustees are for both of these sections. So from a defined benefit perspective, the trustees run and look after the pension scheme, and they also carry out evaluation every 3 years to assess the costs and whether contributions need to change. Whereas from a defined contribution perspective, it's all about making sure the funds available to members are fit for purpose and are kind of meeting their objectives. So in terms of a sort of wrap up then, we covered off why have a pension, the sources of pension benefits and state pension, and given an overview of how the social housing pension scheme works. And in terms of takeaways, I think I've got a mini checklist on the right-hand side as well. So we talked about state pension and state pension age, and I think I'd encourage everyone to log into those websites to find out more, to understand what your benefit projections might look like. We talked a bit about the different types of schemes. I think if you want to find out what scheme you're in, I think one way we'll be looking is looking at how much you're paying towards pension contributions each month, but also be able to log on to the TPT website and to their portal, and that should give you more information as well. I'd also encourage everyone just to kind of spend, if they have a few moments, just to look at their nomination form or their expression of wish forms, just to make sure that the death benefits are payable to the person that they want them to be payable to. And I guess the last point on this checklist as well is really around the annual benefit statement. So this is a statement that's sent out every year that really gives you an idea of how your pension's building up, both from a defined benefit and a defined contribution perspective. I think they're usually sent in the post, and you should be able to access them through the TPT website as well by logging into their portal. If you do want to find more information, I mean, there is a lot to kind of take in there, and you probably have need to go away and think of some of these questions. I think I've put a couple of sources on here. So you've got the contacts at Black Country Housing Group, and there's also links to the TPT website as well. And I will add on to that the member booklets, because they're really helpful. There's also some links below on Money Helper and unbiased.co.uk as well, so they can kind of give you some guidance and information on pension matters, and unbiased.co.uk kind of helps give you access to independent financial advisors if you need a little bit more help with sort of pension decisions. So that really brings me to the end of my session. So if you did have any questions, very happy to take them. Just seen a couple pop through. Maybe Peter, you've raised your hand. Do you want to go first?
Thank you, Tim, for the presentation. Sorry, there's a bit of an echo.
I'll go on mute.
Hopefully that's it. Is there a sort of an industry standard in terms of when making a decision between defined benefit and defined contribution as an employee? When does it become worthwhile considering a change from defined benefit to defined contribution, in terms of, you know, paying 9% at the moment? At what point would defined contribution be more of an attractive proposition? I guess is one question. And the other is, does SHPS have a reputable insurance provider that you default the annuities to if you do decide to go for defined contribution?
Yeah, so both really good questions. I guess with the first one, probably not industry standard, because I think it's a very personal decision. I think one of the things to think about really, and maybe before I go any further, I can't give financial advice, and this isn't financial advice, etc. I guess really it comes down to where's best to put your money. So the word affordability comes to mind. I mean, it's good to save for a pension for retirement, but if you've got a more pressing need, so saving for a mortgage or saving for something else, then many people will choose a lower option than another option. Defined contributions and defined benefit, they both have pros and cons. So defined benefit, arguably you've got a little bit more certainty with it. You kind of know where you're getting at the end of the journey. It's set out in the deed and rules, although that can change over time. Only future benefits that can change, but there can be changes. Defined contribution, I guess it's a double-edged sword. It's more flexible. If investments do really well, you'll benefit from that. If investments don't do really well, then you need to make up the shortfall. So it's all about who's having the risk, who's benefiting from it, and it really is a sort of personal decision as well. Sorry, Peter, you're on mute again. So sorry, Peter, you're on mute.
Sorry, yeah. Is there? I just obviously been talking to myself in the office. I can see Tom laughing at me now. Is there a default provider, a reputable provider for people? Because it can be quite confusing for people to make a choice of an insurance company for the annuity? Is there, does SHPS provide that advice?
I think they will do as part of their process. There are, I think, on Money Helper as well. I think they might help you with that. I mean, it's almost like, when you're buying car insurance or something, you can choose from them. And I think there are like providers that are more household names as well, so like Legal and General and Aviva. And you can, it's a similar sort of decision you need to make as you would do with the sort of car insurance as well. It's like, do you go with a sort of a known one that is a household name, or could you get a slightly better deal with someone that you don't know? But yeah, I think TPT would provide you with that. I mean, I'll double check whether they do have a default. Yeah.
And if you change from DB, last question, DB to DC, would your DB be protected up to the point of time that you paid into DB? Yeah.
So I've got to use the word protected or safe cautiously, because I think extreme scenarios where companies go insolvent, I'm not suggesting housing associations are anywhere near that bracket. But generally, when you leave the pension scheme, your pension is protected. I think of it as frozen, and then it grows with inflation. And if you've been in the pension scheme since the 90s, some of it might grow a little bit higher than that as well. So it's never going to go down; it'll only go up. So it's kind of safe. It's banked effectively.
Well, I'm only 25, obviously, so I've not. Thank you, Tim, for your time.
And I think there was another question in the chat as well. So Cal was first. I had a previous SHPS pension. That's a good question. I think I read something like that, but I think it's probably a question for TPT directly. I think they'll be able to answer that one. And then Sarah, I think you asked a question about you get your state pension in addition to your work pension. Absolutely, you get both, and you can start to take pensions at different times as well. So you don't need to wait until your state pension age to draw your pension. You can start drawing your SHPS pension, your employer pension sooner. And then when you get to whatever your state pension age is, whether it's 65, 66, 67, you can start drawing that pension then. So you have that top up coming on. And I think your second point as well is also talking about, could you type? There are flexible retirement options as well available from TPT, but I don't know how that into, and I don't know whether Sarah or anyone from the HR team or payroll team can help on kind of what facilities are available through Black Country Housing, or whether you allow flexible working, or whether anyone's asked the question before. Are there any more questions? Has anyone got any more questions they'd like to ask? Sarah, should I hand over to you again?
Yeah, Tim, can I just ask another question? Sorry, I could sort of just hog the whole session. When you talk about dependents' pensions or children's pensions, at what age do they stop being considered a child? Is it when they're sort of 18 or once they're working, or?
Yeah, so it is aged under 18 or aged 22 if in full-time education. Okay. There's another point as well. It's any child who is disabled and unable to earn a living as well. So I think it's really with these questions, I think I point people to the member booklet. There's a lot of detail and kind of ifs and buts on these things. So really, rather than me talking them through in detail, I think I'd encourage everyone just to have a read through it. But yeah, 18 if they're not in education, and generally 22 if they're in full-time education. Okay,
thank you. Does anybody else have any questions they've got for Tim before we finish the session?
Oh, there's another hand raised. Sorry, it's Amanda.
Yeah, hi there. Yeah, you touched on although you didn't use the term additional voluntary contributions. So AVCs, are they only relevant to the DC scheme, not the DB scheme? And you touch on, you know, the tax benefit of contributing to the scheme. So are AVCs non-tax, or is there a tax benefit from AVCs?
Yeah. So let me try and answer both of those questions. So let's think of it from a perspective of someone in the DC scheme. So currently paying 4% employee and 4% employer contributions. If you want to pay more contributions, you can do. They go into the SHPS DC scheme. Like normal contributions, they get tax relief and they help to build up your pot. So it's quite straightforward. In SHPS DB, it works pretty much the same, except you're now starting to put money into a separate or a kind of attached SHPS DC pot as well. So you might have SHPS DB for your main benefits and your additional contributions in SHPS DC. And just like SHPS DC and just like pensioners contributors, again, you get tax relief on those contributions.
Okay. Thanks, Tim. Can I ask another one?
Yeah.
Just coming back to Sarah's question in the chat, because I think there's two aspects to that. There's one about the concept of retirement, but you carry on working. So firstly, that thing about, can you carry on working and draw your pension, or is it linked to what the particular pension scheme rules are that allow you to do that? But then I wasn't clear on your answer, so that if someone comes out of the DB scheme, claims the DB pension, carries on working, and can then contribute towards the DC scheme, which is it's quite interesting.
So you can do that. I think those flexibilities are available. I guess it's just kind of thinking about when it makes sense to do that as well. So I guess the sort of normal example is if you're kind of working full time, you want to like partially retire, so you can start taking some of your benefits to kind of top it up and work 2 to 3 days a week. So that's a facility that the pension trust provides.
Right.
I guess where it starts to get a little bit tricky is if you're a higher earner. So if I think probably rule of thumb, if you're around the sort of £75,000 mark, you might be tripping over kind of nuances of the annual allowance regulations. So this is all to do with the maximum amount you can pay into a pension scheme or build up in a pension scheme before you start losing that tax relief. So I think if you're nowhere near that bracket, it's probably not much. You don't need to worry about it too much, but it's worth bearing in mind. But if you are kind of approaching that, then it's something to be aware of, because it'll have these sort of unintended consequences.
Okay, thank you.
Okay.
Hi, Tim. Can I just come in with more of a point of clarity, really? So I think, just to get your confirmation on this. So I think at the beginning of the session, Sarah sort of like, gave a bit of context for everyone in terms of the background behind this session. And obviously one of the key things that's kind of gone on quite recently is in terms of the revaluation, which obviously links to the DB, the defined benefit scheme only. And it's just to give that clarity really and certainty that currently, so the level, as in the percentage of contributions into the defined contribution scheme, which is a combined minimum contribution of 8%, which we currently split 4% member and 4% employer, that there's currently no requirement, if you like, or plans to increase that minimum contribution. Is that correct?
Yeah, so when I guess stepping back, when trustees carry out these valuations that happen every 3 years, that's really to do with pension schemes which have a promise where effectively it's fixed what it is at retirement, and it's all about making sure enough money is put aside to meet that promise in the future. Because there isn't a promise on the defined contribution perspective, that doesn't feed into that directly. So I think any sort of changes in contribution rates would only really apply to the defined benefit side of things, and defined contribution is very sort of separate from that in many ways.
Yeah, thanks, Tim. Thanks for clarifying.
Hi, Amanda.
Sorry, me again. Just can I ask you a question about state pension? Because I think one of the issues, well, is that a yes? Are you happy to answer?
I'll try my best. It's not my specialist topic.
Okay, so, you know, our approach towards our pension strategy is, you know, from a view of inclusivity and acknowledging people at different life stages and what people want for the future. So just coming back to state pension, because, and this is possibly a gender issue, because a number of women might come out of the workplace because of having children, or, you know, people's life circumstances can be different. And that whole issue of keeping up national insurance contributions that determine your entitlement to state pension. So if women have left the workplace, for example, and not contributed, you know, not been able because they've been at home for 5 years looking after their children, is there a way for people to top up that gap in national insurance to give full state pension entitlement?
Yes, and I think if you log on to the first link, which I haven't managed to do myself because you need your gateway ID, I think that enables you to make a top up. But yeah, absolutely, you can top up your pension.
Okay, so that might be something that's worth us communicating to colleagues as part of this process. You know, there's a range of things, isn't there?
Yeah, I guess. Yeah, there's a couple of different things to think about with state pension as well, because there's an interaction between like the single one, and I know there's like a sort of a married state pension as well. So it's there's a number of the number of different variables, which is kind of why I try to direct people to the website rather than try and do a few sort of rules of thumb, because it can get quite messy. But I mean, maybe I should follow up with a few bullet points after this, and we can agree how to share that to you know, steer people in the right direction on state pension. Would that be more helpful?
That would be really helpful, Tim, because I think, you know, in terms of people's long-term financial planning, you know, the state pension is a core aspect of that. And I think, you know, in the past we focused on our own SHPS pension and not really factored in the fact that, you know, people will be entitled to state pension. So if people can seek opportunities to maximise that for their own benefit as well, it should help colleagues. So yeah, thank you.
Tim, there's another question in the chat about spouses' pensions and your children, from Tina.
So if you have no spouse's pension and you don't have any eligible children, you well, I guess there's two parts. If you keep the benefits as they are, the pension benefit will just disappear. I think any sort of lump sum would be payable to an estate if there is a lump sum payable, but there wouldn't be anyone who's eligible for the spouse's pension or a children's pension, and that does happen from time to time. I guess because one of the flexibilities with SHPS is that you can flex that spouse's pension. I think at least at retirement, what you can do is if you're not going to use that part of your benefit, you can have some of that benefit yourself. Does that help, Tina? Hopefully.
Yes, thank you, Tim.
Okay. And then there's another question from Tracy. Yes, so that's a very good question, and I don't know the answer to that just yet. I don't know whether this is a hand back to Sarah.
Yeah.
Or someone for that question.
Yeah. Yeah, we don't know is the answer at the minute. And that's one of the reasons that we're doing this pension strategy review, and we've got Isio on board to sort of help us to try and work out how we navigate through the valuation and what we do with those additional costs. But as we've done in previous valuations, we do come out to staff, so we'll come up with some options and we'll come out to staff and consult on what their views are on how we should move forward. I can't be any more helpful than that at this stage.
There's a question from Kay on the nomination form or expression of wish form. So really that's about directing where the lump sum payment would be due. So the spouse's pension will generally go to your husband or wife or your civil partner. The nomination form primarily is about making sure that the lump sum payment goes to whoever you want it to. I think just trustees have discretion to give that to different people. So I think it's important that you kind of allocate that rather than relying on their discretion when you reach when you actually die. And I think from working on other pension schemes, sometimes it can be straightforward. So sometimes like there's an estate to be payable to, or there is a spouse, but there's only one spouse other than some children. But it can get messier sometimes if say you've got an ex-spouse or an estranged spouse, and the trustees need to make a decision on whether that money goes to them or goes elsewhere. So it's just making sure there's that clarity on nomination forms. There's a question from Joanne: are the defined contributions going to remain at 4%? Again, I think so. Kind of going back to the sort of point a little bit earlier. So any sort of conversations around the valuation, that's really focused on the defined benefit part rather than defined contribution. So I don't think that will feed directly into that. But I think I guess really over to Sarah and Amanda and how that feeds into any sort of wider pension strategy review.
Yeah, again, exactly that. So as part of this review and this piece of work that we're doing, whilst our primary focus, I guess, is on the DB scheme because of the valuation that's come out, it does give us an opportunity to look at, our pension offer as a whole. And back onto Amanda's point of inclusion, we want to make sure this time when we have a look at it that we're being as inclusive as we can, and we're accommodating people at different stages of their sort of life journey. Because the importance of pensions when you're 21 are a lot different to the importance of pensions when you're 55, perhaps, and you'll have different views about what you want to sort of spend your disposable cash on. So all of that will sort of come out in the wash, I guess. Any other questions for Tim while we've got him? No, I think we've finished there, Tim.
Thank you very much, everyone.
So can I say thank you to Tim for that? That was really useful, really informative. And we talk about pensions quite a lot on the pensions working group, but I still feel like I've learned a couple of things myself there today. So thanks, Tim. I really appreciate that. If anybody wants to follow up with any subsequent questions, you can just drop me an email. If you want to know sort of, housekeeping type things about your pension, or where you can get a nomination form from, or if you want us to download you a copy of the member booklet, if you just drop me an email, we can support you. Myself and Angela will support you with that. So yeah, thanks very much, Tim.
Cheers. Thanks, everyone.
Cheers.
Thank you very much.
Bye.
Thank you.
Bye.
Thank you.
Bye.
Bye.
Bye then.